Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Chad here, your hosts for this weekend show. This weekend show is going to be really a big picture outlook on markets, which have continued to show quite a bit of weakness, and trying to make sense of what's going on around the world with the U.S., the ongoing tariff news, and just what it means for markets. Because right now, people are worried about a larger market correction, maybe even a market crash. And clearly we've seen money filter into a lot of the defensive assets. Please, everyone, go back through our website, kereport.com, and podcast or YouTube channel. Just search The KE Report to listen to all our daily editorials and company updates. Without further ado, let's get into this weekend show, kicking off with Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, also editor of the Boock Report on Substack. I'll include a link to Peter's Substack in the show notes on our website, YouTube, and podcast. Peter, let's start off with your take on what's going on globally here. The U.S. seems to be picking a tariff war with all kinds of different countries around the world. That is causing a lot of turmoil in terms of the markets. What's your take from this environment that we are in globally right now?
Well, the tariff situation, just as it did in 2018 and 2019, is causing not just sort of angst and nervousness, it's throwing mud in the gears of business. And people forget that in 2018, 2019, tariffs sent U.S. manufacturing into a recession, and that led to the Fed cutting interest rates in the middle of 2019. I was hoping, knowing that we were going to get tariffs because Trump likes them, for something more sort of strategic and focused with them to achieve whatever goal he wanted. But instead, we've gotten a scattershot approach, and it's creating a lot of problems. And I don't think that this is going to end up any different than it did in 2018, and potentially this can be even broader. Countries are ready for retaliation. We've already seen it today after the steel and aluminum tariffs went on. And I don't think there's enough thought within the administration of the full sort of flow through of an impact that this has. That while you're trying to defend, in this particular case, U.S. industries, U.S. steel and aluminum, you're actually pricing U.S. manufacturers out of the global market, because we're going to be competing against firms outside the U.S. that are going to be able to source their raw materials at a much cheaper price and take market share from us. So I don't see anything good coming of this. I think that the market has spoken. That's just my opinion, but look at the market's opinion. The market has clearly spoken, and it doesn't like it.
Well, and Peter, just to complicate matters even more, I think that some of the farmers have not liked it, the manufacturers have not liked it. There's a lot of boomerang effects with these tariffs because we get the retaliatory tariffs back from other countries, but it hurts domestic and international businesses. But you've been making the point that some of the market correction was already on tenuous ground because of what we'd already seen in the AI bursting with the DeepSeek news, and just some of the valuations being at such a frothy level that things were already looking for a reason to correct, and this tariff uncertainty has just added fuel to the fire. So maybe break down the structural things you were seeing before all this even heated up in the first place.
So with the context that we know, the AI tech trade basically gave the market a second wind in late 2022, early 2023. I think beginning in July of last year, as the markets digested Q2 earnings from all the big names, particularly the hyperscalers and NVIDIA, is the market started to differentiate between those companies, those hyperscalers that are spending extraordinary amounts of money to build out these models, and then the beneficiaries of that spend being NVIDIA, Dell, and other infrastructure providers. But in the hyperscaler viewpoint was, okay, this is a lot of money you guys are spending, and where the revenue is going to come from, and is it going to be eventually enough to substantiate all this spend? And then I think as the year progressed, those questions started to grow. And then, of course, I think DeepSeek was a game-changing event. I mean, my experience in the markets for many decades is when news comes out of nowhere and sort of shakes people, it's more usually than just a one-time, one-day impact. And I think it woke people up to the fact that these AI models that all this money is being spent on is now a commoditized product. And you don't have to be a US company to be able to develop this. You can be one that is located overseas. And so people are now, questioning, well, okay, you're spending $20 billion a quarter, you being, one of the hyperscalers, or $15 billion. And what are we getting for that if other people are doing it and giving it out for free? So I think that was a really game-changing thing. And mid-February, I wrote a note basically saying, I think the AI tech trade is over, in terms of it dominating the markets and it's sort of carrying markets on its shoulders. And what we've seen is that to be the case. But that doesn't mean that, everything else falls apart, because what we've seen is dramatic outperformance in European markets for, specific reasons there, whether it's a huge amount of defense spending that we're going to see, the realization on the part of important politicians in the EU that they've smothered themselves from a regulatory and red tape perspective, and even just Germany recently easing their debt brake constraints. And then, of course, we've seen a nice rally in China, sort of triggered by the DeepSeek news, but people realizing that there are other stocks to buy other than the top 7. And then, of course, so that created an underlying fragility, in my opinion, when you have 35% of the S&P 500 being in these 7 stocks that's all of a sudden faltering. You better hand the baton off rather quickly to somebody else if you're going to maintain, S&P levels. And, you couldn't hand it off fast enough to other things. And then you throw in the tariffs and just worries about economic growth, because, the 3 areas of economic strength, I've argued, has really been government spending and anything related to that. Well, Doge and the intent of shrinking the budget deficit relative to GDP to something closer to 3 rather than 7. Well, that's a great thing, I believe, longer term, but in the short term, that's a major economic constraint potentially. You have AI spend has been a major driver of economic growth, whether it's hiring engineers or building out data centers. Well, now that's potentially in question or now we're getting to the point of, are we overbuilding? And then upper income spending. And if the stock market continues to fall, well, then upper income spending is at risk. So no coincidence that today it's sort of flat. The 3-month and 10-year yield spread reinverted again. So I think there's legitimate concerns about the economy rolling over into recession if these 3 pillars of economic growth start to falter, because other parts of the economy are already in recession. Manufacturing is in a recession. Low to middle income spending is in a recession. The pace of existing home sales is in a recession. Global trade is essentially in a recession. So I think there are legitimate concerns out there, and I think it's easily explainable why we've had this pullback in markets. And then you throw in, overvalued markets with this vulnerability that's growing, and it helps to explain what's going on here.
Let's dissect this market pullback a little bit more and get your opinion on just how deep it could go. Because, look, the market's lost a lot of momentum in December, I feel like. Did reach a recent all-time high in February. I'm looking at the S&P. But then we've had this 10% decline in 4 weeks. Now, the 10% pullbacks are normal for markets. We had one back in July, but that one only lasted about a month. And then in 2023, we had a longer term pullback there. But again, this 10% decline has come in really under 4 weeks. It's been very quick. How much lower could this market go? Are we talking about a correction here that could last the rest of this year?
Corey, I don't know. I don't know whether the big 7 stocks and what I said with the recession drag us down. Well, if we go into recession, market's going much lower. Trying to quantify it, I've gave up that game a long time ago. All I know is that risks are growing. Valuations have given the market no room for error, and you got to be more careful. I do think, though, that there are opportunities out there. I mentioned international, and I do think that this international outperformance is not just a few month thing. that it's a multi-year thing. There are a lot of attractive markets or a lot of cheap stocks out there overseas, and there are cheap stocks in the US as well. But I think you have to understand of sort of the investing playing field that we're on right now is much different than what people have gotten used to. And what is going to work in the coming years is going to be much different than what has worked in the prior few years.
Peter, I want to go back to something you said just a little while ago about the government spending aspect to how that figures into growth in the United States. And if the Doge committee is cutting jobs and cutting government spending, you're for that as a longer term thing to reduce the debt and the spend. But how does that affect the growth in the U.S.? Is money fleeing the U.S. to other countries and other markets because they're concerned we're going to have a recession? Are we in a stagflation? How are you looking at it?
So with the dollar, it's actually very interesting because, obviously the world's so interconnected. And I'm going to go back to, the Mag 7, for example. The Mag 7 stocks literally became like a reserve asset for foreign holders, foreign central banks, just as US Treasuries were a reserve asset, gold, a reserve asset, big cap tech became a reserve asset. And just to define that, the Norges Bank, the Norwegian central bank, as of December 31st, was the 10th largest holder of NVIDIA. They owned 324 million shares of NVIDIA. The Swiss National Bank, as of December 31st, owned 90 million shares of NVIDIA. The whole world has piled into these stocks. So it's no coincidence as money is leaving these stocks, foreigners selling these stocks, the dollar has correlated well with the Mag 7. As the Mag 7 has fallen, the dollar has fallen, and vice versa. So there are major global fund flows that are driving things here as well and influencing the value of the dollar relative to those stocks.
With these policies that Trump is enacting, and quite frankly, the tariff war that is ongoing and seems to be ramping up with different countries, and now money moving into other markets outside of that U.S. dominance that we've seen for so long. Peter, do you think this is a bigger picture end to U.S. dominance here, where other countries find other trading partners and investors, kind of going on that last thread, just turn their back on U.S. markets?
I think maybe to an extent, the U.S. is always going to be a very fertile place to invest for many different reasons. But, on the margin, could money start? I mean, that's the thing is when you start to sort of take a baseball bat and start banging your trading partners over the head, they start to lose confidence in their desire to do business with us. And not just at the business level. I mean, even on a travel perspective, I hear stories about Canadians canceling their trips to the US and liquor stores taking Jim Beam off the shelves and California wines. And I mean, look what we've done to Europe. Europe is now going to spend a lot of money on defense, but they have very little interest in buying stuff from US defense contractors. They'd rather buy it from their own. We've emboldened the Chinese to build out their entire, tech sector. And which means that as they become more independent of us, the US chip sector, for example, is going to lose China as a customer. And not only lose China as a customer, could lose the entire Asian region as a customer. Because if you are in Japan or you are in Singapore and you have the choice to buy some tech product from China or the US and China can produce it cheaper than we can, well, who do you think they're going to buy it from? So this antagonistic approach towards our trading partners has the potential of backfiring. And it's something that I'm concerned about. And we'll see. I mean, I'm sounding maybe overly cautious. I mean, like I said, the US is still a phenomenal place to do business in and invest in. But we'll have to see, when you bully somebody, there's a response, and we'll see to the extent of that response.
Well, Peter, you're not the only one that's in a defensive posture. It seems like most of the market is as well. There's a definite shift from some of the growth areas into value sectors like consumer staples or utilities getting a bid now. We've seen bonds get a little bit of a bid, but gold has definitely been picking up steam throughout the course of 2025. It's still over 2,900 at the time of this recording, and central banks around the world are buying a lot of gold. Is that part of the defensive playbook that other nations are using too and other citizens are using, is just buying into the precious metals as a store of value?
I think there's no doubt. We certainly encouraged we, being the US and the EU, encouraged foreign central banks to own a lot of gold after Russia invaded Ukraine and half their central bank's reserves were confiscated, as we know. Then you fast forward to now, and you can imagine that foreigners are even more inclined to reduce their exposure to the US dollar and own more gold. So I think that's why you've seen a pretty persistent bid to gold, and even silver is catching up to gold. It still has a long way to go, but there's a bid to silver too. So I would definitely connect the dots to what is going on geopolitically, and certainly, the economic weapon of tariffs leading to a rise in the price of gold.
From this point, what continues to drive the gold price? Is it just more of the same, more of this fear coming into the market, or is there another catalyst you think that is needed to push gold even higher?
Well, I'm never a fan of, people have fear and let's buy gold. Gold's usually rallying for some other reason, whether it's a weaker dollar or falling real rates. To me, the next catalyst to take gold much higher is finally the Western buyer taking gold higher. If you look at total ETF holdings of gold, it is still dramatically below its peak of 2020. There was over 110 million ounces of gold in these ETFs. Today, there's just 86 million. And it really fell precipitously beginning in March 2022, and the Fed started raising interest rates when Western investors said, hey, I can, and other central banks did as well, I can start getting yield for the first time in 15 years. I'm going to start buying bonds. Who needs gold? It doesn't pay me anything. Meanwhile, the other parts of the world saying, give me gold, give me gold. So I think now you have the possibility of a big catch-up trade where the Western world starts buying gold, and those ETF holdings get back to where they were at the peak in 2022 and the previous peak behind that, which was even higher in 2020.
Peter, you brought up the Fed there, and let's bring them into the equation as well. They have a big impact on interest rates. Of course, their two mandates are inflation and employment, but a lot of people came into this year and really came into the end of last year expecting more cuts. I don't know where you stand on the cut factor, but the market's all over the board and it's been up and down as far as the expectations. How do you think that plays into interest rates? How do you think that plays into the dollar?
I think the Fed's in a really difficult spot here because of the tariffs. And I say that because first, going back to the 2018 example, and the Fed was going to dust off that sort of playbook that they were cutting rates in summer of 2019 in response to the manufacturing recession that tariffs caused. But, they were able to do that because there was no consumer price inflation. There was producer price inflation. Companies had an increase in their costs, but they ate it instead of passing it on. This time around, companies may feel more licensed to pass it on. Also, what happens if the Fed starts cutting rates and Trump wakes up the next day and says, okay, I changed my mind, the tariffs are off? Then the market rips and the economy rebounds and the Fed just cut interest rates. So they're kind of frozen, I believe. Now, that said, if the unemployment rate rises, the last payroll number, the U6, the all-encompassing unemployment rate, rose to 8% from 7.5%. It was a 50 basis point rise in the unemployment rate in 1 month to the highest level since October 2021. That had me concerned. If the Fed starts cutting interest rates in response to that, I don't think they're going to be able to get away with too many because of the because of the issue with the tariffs, and maybe they get taken off at any point in time. So it's a really tricky component here. And I just think that, investors who are, so used to the Fed bailing them out with a cut or a string of cuts, I just think they can't hang their hat on that.
Just such a fickle market now, especially with Trump in office. You just don't know what's coming. And I think it's not just the Fed that feels handcuffed. There's a lot of investors that just don't know what to do right now. We've outlined how gold, silver, those are doing well. The international markets, those have seen money flow into them. Any other areas out there, Peter, where you're seeing an opportunity for investors that could say, look, I want to put my money somewhere and not have to worry about the day-to-day craziness that we get out of politics, somewhere that maybe could play some catch up to what has been pretty good market environment for investors over the last few years?
I'm getting more and more positive on commodity stocks. I see just major supply deficiencies building. And I think tariffs are going to just muck up, the global supply chains and increase the demand and desire to hoard commodities. And I'm just looking at I love the chart of the CRB Raw Industrials Index. That's as of yesterday's close. I'll get a fresh close in a bit today. Closed just shy of a multi-year high. And the chart just looks like it's carving out a classic bottom here. Copper today traded at the highest level since May of last year. I mentioned silver before. So I think there's some real opportunities in commodity stocks, particularly industrial metals, very bullish on ag. And to me, energy, particularly natural gas, but oil at below $70 is dirt cheap.
To that point, energy, nat gas has been on a tear lately. Oil has been kind of the opposite. It's been in a downward pressure. How do those factor into your outlook on inflation? Because energy is such a big part of inflation.
So yes, so the price of oil is down, price of gasoline is down, but then we have the price of natural gas that is up notably. So there's some gives and takes, but I don't think that oil stays down at these levels. I know the Saudis and OPEC just announced a modest increase in production, but I think supply out there is actually tight if you look at the inventory numbers. Demand obviously is a question. If the U.S. economy goes into recession, well, China's reduced its demand. So no doubt there's a demand issue, but I think down here below 70, it's pretty cheap.
So since you like the commodity stocks, how do you play them? How do you play copper stocks? How do you play gold stocks? How do you even play energy stocks? What's your preferred method?
So we're along some of the big European ones because they're much cheaper than the US ones like BP and Shell, long Canadian natural resources, as I think it's one of the best run oil and gas companies in the world. EQT and the pure natural gas play and some of the natural gas pipelines. Fertilizer stocks were long a bunch of the gold and silver miners, but also that have copper businesses as a play there. We don't own Freeport. We used to, but you can own that as well. And just I'm looking at other industrial metals to possibly own, and also not forgetting about uranium, which we're still long. That is pulled back here, but still bullish there as well.
Any concern that if we do have this contraction that some are worried about, that would crimp commodity demand? And could we be entering a stagflationary period where there's just very little growth? How would that affect commodities?
Well, yeah, there's definitely risk on the demand side for the reasons that I mentioned, but partially maybe offset by the hoarding potential that I talked about, and issues with supply. So I think commodity investing generally, it's you got to pay a lot of attention on the supply side. And now with respect to gold miners, I don't necessarily have to think as much about the economy, right? In fact, if the economy falters and the Fed's cutting rates, that's going to help gold even more. So you got to think about that as well. And with respect to ag, the global demand for food is going to continue to go up. And so I think fertilizer stocks also less worried about the cyclicality of the economy and just focused more on the supply side of, potash and phosphate and nitrogen, for example.
Yeah, that's such a good point about precious metals, even ag too. But when it comes to more of those industrial metals, what about China? How much does that filter into your analysis? And what is your outlook for China? It's seen a bit of a rebound, but still nowhere to the extent that China bulls thought even a couple of years ago.
Well, China's still struggling with the downturn in their housing market, which is still probably years to go, but the pace of deterioration, I think, is really slowing. The pace of housing price declines is slowing. So that is, to me, a very big deal. And it seems that China sort of got some of its mojo back with DeepSeek, and also Xi meeting up with a bunch of tech executives. Like he's sort of blessing them again. They made a colossal mistake by banging their innovative tech entrepreneurs over the head. And now that I think they realize the error of their ways and they're trying to bring them back into the sort of the politically friendly fold, I think that's a really big deal. And China's dominating in EV manufacturing and solar panels and the electrical and robotics. And I mean, they're doing a lot of exciting stuff. And, we've emboldened that because we've incentivized them to figure it out on their own, and they are. So I'm actually think people have left the Chinese economy for dead, and I think that's a big mistake.
What about critical minerals? They were the flavor of the day a couple years back. Everything was focused on the energy transition, on EVs, on renewable power, and the huge demand there would be for things like lithium, cobalt, but nickel, copper. Now, with the Trump administration coming in, less of an interest in that narrative, but still a lot of policy initiatives that were already put into place. How are you looking at things like critical minerals?
I mean, critical meaning like rare earths, for example.
Well, just any of the things for the energy transition, lithium, nickel,
Okay,
copper.
so those, yes, yeah, right, yeah. The energy transition has definitely been stunted. I think physics, the reality of physics, has all of a sudden mattered, and that people have realized that wind and solar is not necessarily the most efficient way of garnering and storing energy compared to nuclear, for example. But there's still going to be renewable build outs, and lithium. There's still a lot of lithium out there. So I know prices have collapsed and, maybe there's a trade there. So I don't have as much of opinion on lithium, but, more so copper and nickel and some of the others that, again, if, these tariffs, while specifically it's on steel and aluminum, there's a desire around the world to get people's hands on these critical minerals. And as I keep using the word hoarding, to hoard them because people understand the importance of it.
All right, Peter, we'll wrap it up here. It sounds like there could be a pretty significant shift here into commodities. For investors, commodities, hard assets really have been left behind over the last couple decades as more money flew into financial assets. But maybe it really is changing this time, led by politics and also just led by what happens. In markets are cyclical, and maybe it is time for commodities and even the commodity stocks to pick up some of that money that flew into all these other tech stocks and all the other sectors. Again, Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, also editor of the Boock Report on Substack. Highly recommend you follow Peter on his Substack to stay up to date on a daily basis. Key news, data, and market moves that he highlights to his subscribers. Peter, great having you on the show. Thanks for taking time with us.
Thank you guys. Appreciate having me on.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. We are now in the back half of this weekend show, shifting our focus to the precious metals sector because, look, that sector is drastically outperforming pretty much everything else in the markets. Gold continues to push higher. Silver had another good week, and the gold and silver stocks also joining into the party. It's actually been a commodities rally too, with copper also doing quite well. But again, most of the focus here being on the precious metals, what is driving the metals continuously higher and what's separating them from the markets, as well as diving down into some of the equities. We're chatting with Brien Lundin now. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference, this year happening November 2nd to 5th. Brien, before we get into sector-specific comments, let's quickly recap the conferences in Toronto that you just attended, the Metals Investor Forum and the PDAC conference. Look, this is a bull market that we're in. So some of the comments I've heard is that the mood generally was better there. And hey, there's people making money in the sector. So what did you take away from those conferences?
Yeah, thanks, Corey. They were good. The Metals Investor Forum had great attendance. I think if you were to throw out the Vancouver event a month earlier, it would have been the best attended ever. But the Vancouver event was just bursting at the seams of attendance. But this one was great. A lot of good companies. And I think at that conference, more so than the big circus that PDAC is, you get a feeling for the enthusiasm of the individual investors. And it was very enthusiastic. There's a sense of FOMO kind of creeping in. We especially saw that between the January events and this March event, that FOMO started to creep in the market. And then we had that big correction. But Nobody was really fazed by it. We gained over, $200 in the gold price over the course of about a month, and we had given about $100 of it back. Not that bad. We were lamenting over the fact that we couldn't maintain $2,900 on the gold price when a year earlier, we would have been stupefied by that fact. So it ain't bad right now. And as we've seen since then, and actually even during that event, gold already started to rebound. And the mining stocks, unlike or better than at any point over the past year. And this event marked the 1-year anniversary of this latest gold bull market. The mining stocks have begun to really respond and leverage the metals. Unfortunately, on that little pullback that we got in that correction, they also leveraged to the downside. But the essential point was, and that I made to the audiences that I spoke to, was that investors were now using the mining stocks as a way to leverage the metals. And that's what we were waiting to see happen, and it's starting to happen now.
Well, Brien, just to that point where investors are finally using the mining stocks as a call option on higher prices and as an outperformance mechanism, and we're finally seeing it reflect in a lot of the mining stocks. We are talked a little bit off mic about how even lately you've put out some information on social media, and other people have been echoing the same point, that we're finally seeing pretty good performance that stands in stark contrast to what we're seeing in U.S. equities. As they've pulled back and had a lot of red days, sometimes the only thing in the green are the value sectors. It highlights the strength that gold has had. But again, silver's been peppy. It's above $34 at the time of this recording. And we've seen the gold and silver stocks finally responding. Is there money rotation coming out of some of the other sectors and finally rotating into the sector, new money?
Yeah, there is, and I think it's very important. And that post I made on X got a lot of traction. But I'm not the only person, as I pointed out in that post, that has been talking about that. Roy Byrne has been talking about it forever. Ronnie Stofley has been talking about it and noting it. But over the past few days, as we speak, and really this week, we saw the gold divided by S&P 500 ratio really break out from a 4-year base and break above previous highs. And we are seeing that rotation. Both of you know that I have been somewhat skeptical of the point that Jordan and other people have made, that we really need a serious stock market correction, if not a crash, to get a breakout in the metals and the mining stocks. I just really have believed that Fed policy drives everything in the markets these days, and any sign that the Fed is going to loosen again would drive all the risk assets up, including the metals. And of course, to some degree, that's happened, but we haven't seen the mining stocks respond. And I've kind of evolved my view to understand and to appreciate that we really need to get the investors involved in the market. We need that rotation out of other risk assets into risk assets like mining stocks to see the outperformance in that sector. Most of, if not all of, or I guess the vast majority of the demand for metals, for gold and silver so far this year, primarily gold, has been insurance and not investment oriented. And we really need to get the risk takers, the traders, the investors who are looking for some torque on the move to come into the market, rotate into the mining stocks. And again, this sector is tiny compared to all of the huge pools of capital that are sloshing around the world. So just a little bit of a shift in allocations is going to have a tremendous effect on mining equities.
Brien, as much as central banks, the Fed in particular, drive policy, look, this just seems like a perfect storm for gold right now, even outside of Fed policy, because we'll hear from the Fed, I believe, next week, but they're not expected to cut rates right now. We've heard, even in the earlier part of this weekend show from Peter Boockvar, that the Fed is kind of stuck right now because of what's going on politically here. We have trade wars that the U.S. is instigating pretty much around the world, economic uncertainty that includes negative GDP forecasts for the U.S. So that whole negative economic aspect for the U.S. Tariffs are a major concern. That seems to be on not just traders' minds, but on governments' minds that ties in with that trade war. And there doesn't seem to be an end game, at least right now, to these tariffs. It's kind of a new mix that we have here. So isn't it more than just the Fed policy? It really seems like everything is lining up for gold in terms of that defensive trade. People don't know what to do with their money now, and clearly they're not comfortable with the economic and political environment in the U.S.
Yeah, Corey, I think you put your finger on another important development that we're seeing right now. To a ever greater degree over the past 4.5 decades, Fed policy has dominated investment analysis, and especially after the 2008 great financial crisis. But we are seeing more factors come into play right now, for better or for worse, with the tariffs, with the inflation picture, with the fact that the Fed has to roll over, refinance between $7 and $9 trillion of debt this year, without eager buyers out there like it had in the past. So the Fed is trapped. I think the markets are recognizing that. Tariffs are highly inflationary. I think markets are recognizing that. And as they look ahead, again, for the insurance reasons, investors and savers and institutions and central banks see that gold works no matter what happens as we look ahead. And investors tend to flock to whatever is working. And if gold is working, then they want to gain leverage on that. And more than that, if gold is working in the broader equity markets, the Magnificent Seven, the AI thing, Bitcoin aren't working, or at least are less certain, then they have to put their money in something that's going to generate returns, and they're going to start following the leader.
Well, and Brien, just to add even another layer of things onto the mix that are working beyond just Fed policy, beyond just tariffs and geopolitics, there's also Q4 earnings that just came out. And like we hoped would happen, it's pretty evident to the world now that the gold and silver stocks that are producing these metals are making some of the fattest margins they've ever had. Record revenues, record margins that we've ever seen in the industry. And at a time where other sectors, maybe that spent too much on AI or invested too heavily in tech or growth, are struggling to have good earnings reports. So it's also a stark difference between the earnings reports from the metals sector versus a lot of other sectors. And you're looking at the economic studies that have come out on development stage companies and going, holy cow, at today's spot prices, look how much better the margins are, the NPV, the IRR, look how much better these economic reports are. Do you think that's yet another layer, just strict outperformance?
Yeah, and we've been talking about this all year, that it's going to happen. And in the markets, or the broader markets, Main Street and Wall Street, can't ignore bottom line returns. And that's what the miners are delivering to the market right now. It was a little bit choppy. We had some issues with some of the companies. Newmont had to digest Newcrest, had their costs higher than expected, their ASIC higher than expected. We had problems with Barrick, with Mali, et cetera. All that's starting to fall into the rearview mirror rather. And now we're seeing these very thick margins and huge profits, and the miners are going to have to put it to work. But the comparison, as you mentioned, with the other sectors is stark, and it can't be ignored any longer. We hope we'll start to see some M&A activity, but even beyond that, you have a lot of the juniors, as you mentioned, a lot of the juniors that have big resources, and we've been talking about that over the past year. The companies that were at one point optionality plays, out of the money at current gold prices, are now wildly economic. And I think that's going to be the next shoe to fall, that the market's going to start recognizing that these companies have to be re-rated. So that remains, in my view, a big sector of the market that going forward can offer drill hole returns with much less risk.
Brien, what comes first here in terms of kind of a chicken or the egg thing? Is it a re-rating in the overall sector of especially these, let's say, development plays, many of which already are doing well? Or do we start to see some of these assets actually getting built, whether it's through M&A or quite frankly, some of these companies just being able to access the funds needed to actually move a project forward, almost like a Skeena situation where people were wondering if it was going to be bought out, but now they've shored up the financing and it seems like they're going to go at them themselves and build it.
Yeah, let's hope it's the re-rating, because the whole building part extends that process into years. But I do think that's going to happen. We're seeing groups able to attract big financings, a lot of them from Wall Street rather than the typical sector investment banks. So that's happening, and that will happen. But I think the re-rating will come first, because it really has to. If you're going to finance projects, it will happen. But there's attention being paid to companies when they put out good news. You know, one of the stalwarts of our gold newsletter portfolio is Meridian Gold, and it put out news on or released a PEA on its project in Brazil, and it was up 17% on the day that gold was losing, just shy of 1%, and we saw the Dow shedding 1,000 points. That stock was up 17% that day. So even in the face of headwinds like that, good news is starting to get traction in the market.
Brien, do you think sometimes our sector is even too volatile to attract certain generalists? The reason I ask is, look at the big deal people are making about a 10% drop in the S&P. They're acting like it's the end of the world. We see 10% drops and 10% pops every day in almost every stock in our portfolio. Like you're saying, stuff up 17%. We saw stocks up over 20% this week. Some stocks down 15%. Do you think the sector is just too volatile for some people to stomach?
If you're looking at pension funds and the like, perhaps. But, volatility is also to the upside, and upside volatility just attracts more buyers, more investors, more traders. And that's what we've had. That's the kind of volatility we've generally had. There's volatilities everywhere in the broader markets. We're seeing stocks, if you watch CNBC over the last couple of weeks, you're seeing stocks that are down 20% over a couple of weeks that were previously the darlings of Wall Street. And of course, Bitcoin has been known for that kind of volatility, but it still attracts money when it's on an uptrend. I think what we're going to see this year in metals and miners is that from a macro perspective, a lot of trends are going to come to their crucial turning points. A lot of chickens are coming home to roost. I think this is the year it happens. And the metals and miners are going to respond to the upside, and that alone is going to attract a lot of trend followers.
So right now, as we said, gold stocks outperforming the markets. This can bring in trend followers because, quite frankly, the gold sector probably has one of the strongest trends throughout this year. GDX is up about 25% just this year. The S&P down about 10%. Now, Brien, what about that balance, though? We do hear that gold stocks are also stocks. So if the markets go through a prolonged correction, even a crash, does that worry you about the gold stocks? Or do you think there has been this separation now where the gold stocks could weather a storm that is a storm of the markets moving down significantly more?
Yeah, let's not fool ourselves. If there is a liquidity event, a liquidity vacuum kind of an event, and we've seen this, of course, in the great financial crisis, the COVID crisis, et cetera, everything gets sold, even gold, even silver, et cetera. And mining stocks being papered, they're going to get sold off as well. But it's a short-term reaction because the Fed and the other central banks around the world will then very quickly come in and they will just blow your socks off with what they're going to do in terms of market rescue policies. They are going to have to do more than they did in COVID, many times more, very quickly to get the same kind of reaction from the markets, and they will. And of course, we saw in COVID, that was many times what they did in the great financial crisis, because the markets, investors, the economy has become addicted to ever easier money. Therefore, they have to keep ratcheting up the rescue efforts. So they're going to come in, and that liquidity event will soon be forgotten, and everything will pop up very quickly. You can't plan on that, though. You can't say, well, I'm going to wait till we have that crash and buy during the fire sale. Always great to have some dry powder, but if you wait for that, you may miss, and very likely will miss, much of the gains ahead. So my policy, as usual, is to make sure you're positioned, make sure you're well allocated in the sector, and keep some powder dry. Be prepared to buy if there is that kind of liquidity event, because that's one of the surest things we've seen in very uncertain markets, is that when you have those kinds of steep sell-offs on a crisis, the market's going to pop back very quickly, because the central banks are going to come in and opening the floodgates, and they're going to float everything right back up.
Well, Brien, the central banks have been the ones really behind a lot of the move higher in gold. Now investors seem to be getting on sides with these moves, not just in the East, but finally in the West. Gold is the prime mover, but we can't ignore that silver has actually had a pretty good move. It's not up in their all-time highs and making new all-time highs like gold, but it's above 30, it's above 32, it's now above 34. If it was to really break out, a lot of times silver is the dark horse that comes from behind and surprises people. How are you looking at silver and silver stocks, their optionality in this kind of environment?
Yeah, I remain committed to silver. It's in a monetarily based bull market, which this is. Silver has always outperformed gold, and therefore, I think it's going to happen again. I think that there's another component now. You all know that I've been famous for dismissing the industrial angle for gold. I think that's hurt it more than helped it over the years. That said, my sources in the physical metals market, the physical precious metals trading market, say that there's a big silver supply crunch in play right now, and it's being driven by industrial demand, not as much monetary demand as we've seen in the past. So I've been predicting, and pretty vocally at these recent mining conferences, that we were about to see a big pop in the silver price. Now, I think the current one we're seeing right now is silver being drawn up by gold, but it's been frustrating. It hasn't been able to break out. $33 has been a key point, strong resistance, and it's broken through that right now. So I think this is very important. This could be the breakout, but we've said that before. Until we get well past $35, I'm not going to get too excited. But I do feel that move is inevitable, if not imminent.
Brien, I want to go back to something you said about that whole portfolio management there, and how you are keeping at least some cash on hand in case of a liquidity event. Look, just looking at this bull market, this is the textbook bull market action. The winners keep on running. The better stocks keep on running. The juniors, broadly, they are not getting revalued, but some are. But when the juniors get broadly revalued and move so much higher, that can usually signify the end of a bull market. Also, tie that in with silver. Sometimes silver, when it spikes to $50, that has also signified at least short-term, if not longer-term top there. So when you're looking at your portfolio, I know you do lean to some of these smaller junior stocks, but what do you think is a good balance there of holding some of these winners, holding some of these larger stocks that continue to move while you're still waiting for the juniors to move? But again, you don't want to be left behind because there are so many precious metal stocks doing well right now.
Yeah, you have to look at every holding you have, every company individually. You want to have a mix, and you have reasons why you bought these stocks. But what I'm doing personally right now is going through some of my winners that maybe look like they're starting to get into the belly of the Lassonde curve. That in 3 years they'll be much higher, but what are they going to do over the next year, 18 months, compared to other companies that I'm seeing right now? So I'm starting to go through and kind of turn the soil in the garden, as it were, and trade some of my winners for some earlier stage companies, or companies that have some kind of a catalyst coming up, or maybe will be re-rated in the current market environment. So that said, selling some of my winners that have built up, some capital, some value in my portfolio, I'm starting to deploy into earlier stage stories that I see coming out. We've recommended 4 over the past couple of weeks in Gold Newsletter and our Gold Newsletter service. And I'm also focusing on some of the larger resource plays that we talked about, companies that have big resources, primarily gold in the ground, and really, I think, need to be re-rated by the market in this current atmosphere. So those are primarily the 2 sectors that I'm putting money into right now.
All right. Brien, we're going to wrap it up here. Everyone, thanks for tuning in to this weekend show. Again, that was Brien Lundin, editor of the Gold Newsletter and our host at the New Orleans Investment Conference. Everyone, please go back through our website, podcast, and YouTube channel to listen to all of our daily editorials and company updates from throughout the week. And please keep in touch with Shad and I through email. We love hearing from each and every one of you, and we really appreciate you taking some time over your weekend to listen to the show. Brien, thanks again for your time, and everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
Thanks, guys.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.